A lot of people saying inflation fears were behind the recent market sell-off. So how hot actually is inflation right now? Steve Leisman is taking a look with our inflation thermometer. Steve?
Yeah, thanks, Kelly. The market's strong rebound this week makes it seem like it's gotten past the inflation fears, even though indeed bond yields are higher and the inflation data has come in pretty hot. Well, how hot, you ask? Take a look at our inflation thermometer, how this week's data measures up. First thing we're going to look at is the core wholesale price one. That was pretty hot for this month, but last month was negative. It was well above expectations this time, but not out of line. It's kind of modest right now. We'll look at it year over year in just a second. Empire State Manufacturing Index, they have a prices paid component. That came in at a 6-year high, up 12 points to 48.6, the hottest in 5 years, actually. And then same thing with Philly Fed, hotter still was their prices paid component, up 12 points as well. Hottest in 6 to 7 years. The hottest of all is over my left shoulder here, the core CPI, the hottest month-to-month gain we've seen in 11 years. But when we take a step back and we look at it year over year, a little bit of a different picture. The year-over-year change on the CPI is really quite modest right now, 1.8%. We could see that move up a little bit more if we get numbers like we had this month. And the wholesale price number is even higher. You can see that in this next chart we have up. When we look at them, so you see the stable core CPI with the rising PPI. And that maybe suggests some profit margin pressures for companies. Let's take a look at what is now several significant dates when it comes to thinking about inflation, or the thing that's on the market's mind here. Our new Fed chairman, Jerome Powell, gives congressional testimony February 28th. Get an idea there of his ideas about inflation and the overall economy. March 1, the Fed's preferred inflation indicator, the PCE, along with some manufacturing surveys with some price data in it. And then this big one here, March 9th, has the wage data, the jobs number and the wage data that ended up spooking the market 2 weeks ago. And CPI and PPI, put those on your calendar, guys, because those are now important events for the market, Kelly.
Yeah, major ones. Steve, good stuff. Stay with us. Let's bring in Larry Kudlow, CNBC senior contributor. We're also rejoined by Sarat Sethi in our panel here. So, Larry, first of all, how hot do you think inflation really is?
Well, actually, I want to break some news today on the show. I basically agree with Steve Leisman.
I thought you might.
I basically agree. There is a whiff of inflation. It's a small one. I wouldn't get hysterical, but I think he's right, and I'll go to the core of it.
Wait. But what are you agreeing with? Are you agreeing that there's a small whiff, or that overall there's not that much of it?
Both.
Or
a small whiff, and overall it's not that much.
I think to associate myself with my colleague from Connecticut's comments.
Listen, I've looked at this. I had a long talk today with Arthur Laffer about this point. The dollar exchange rate, the DXY, has gone down about 10% over the past year. And by the by, the gold price has gone up about 10%. And I think the inflation rate, the basic inflation rate, which is the PCE deflator, which has been running at 1.5%, I think that's going to go up by about 10%. This is just back of the envelope stuff. So 1.5, you go to 165. It's up by 15 basis points, 10% times the 1.5. But I think it's essential, and I'm worried about this a little bit more than I was a week or 2 or 3 ago. It's essential that the dollar stabilize, and I would like to see the dollar a bit higher from these levels. I don't want it to drop any more. So therefore, the Treasury needs to talk well of the dollar, not badly. The Federal Reserve should retire reserves, keep shrinking their balance sheet, and raising the target rate.
Larry, what you're saying is you don't see a lot of inflation pressure from here, a lot of inflation pressure, unless the dollar really starts dropping. Am I getting that right? You're not one of these people who says it's coming, it's here, it's going up, we're at an inflection point.
I don't agree. As you know, Kelly, I don't believe higher wages cause inflation. I don't think more people working successfully causes inflation. I think inflation is still bad money, excess money, but you can't look at the money supply anymore. So for many years now, I've used the dollar as a proxy, and I like to cast an eye on gold and commodity prices. There's no question that those indicators are showing a bit more inflation. So is the TIPS spread, the break-even spread, slightly more. Most of the rise in rates has been from real rates off the tax cuts and the stronger economy. But yes, I can see it. I think Steve is right. And
so let me bring Sarat in here. Sarat, what is the stock impact you think is most likely from the trends we're seeing right now?
So I think if you see inflation coming back, you want to own companies that have pricing power. You want companies that can pass it on to the consumer or to corporations. So in that vein, you got banks. Banks are perfect companies that have the ability to take interest rates as they go higher, lend at a higher rate, maybe not give the rates that they want. Business is going to start doing better. They're going to make more money. So companies like Bank of America, JP Morgan, First Republic, all those companies are going to do well in a time like this.
Would you steer completely clear of bonds?
I would stay, if we fear inflation is coming, you want to be out of the more than 10-year bonds.
But when you say inflation's coming, do you mean accelerating inflation, or do you just mean we have inflation at all in the 2% range and that's the end?
Well, we have a lot, I would say more inflation than we've had over the last couple of quarters. So the question is, what is the trajectory of that inflation? And that's what the market is trying to say. Because if that second derivative is manageable, then the stock market won't get these huge hiccups. But when we get stuff like, you go to 2.9 and we can go to 3.1, that's going to throw some algorithms off, and you're going to have short-term fluctuations.
Steve?
Kelly, I think you have to ask yourself a basic question here from an investment standpoint, and that's, are we seeing a cyclical uptrend in inflation in an otherwise secular downturn in inflation? And I really subscribe to some of these secular forces here, and that's globalization, that's technology. All of these things drive down prices. I was looking at a report, I'm not ready to talk about the details yet, but somebody looked at internet prices and found those same prices included in the CPI are actually much lower on the internet that is included in the actual inflation indicator. So I think those forces are out there. I think what you have is a cyclical uptrend, a firming of inflation, something for investors to take note of. But I think the bigger and more important thesis here is one of technology and ultimately globalization.
Well, on this point, by the way, on this point, once again, I am forced to agree with my colleague and friend.
It's not so
Steve
bad,
Leisman.
Larry.
It's not so bad.
Come on over. It's great.
It's very enjoyable. I don't believe in the cyclical stuff, but we'll put that aside for a moment. What I do want to comment on, the market professional you have, I think a tiny whiff of inflation. And I'm looking at, maybe it's going to go from 1.5% to 1.75% at this point. Now, if the dollar keeps falling on a sustained basis, that's bad. And that's going to drive up inflation to 2 or more, and that'll push up interest rates. But, sometimes a little tiny whiff of inflation is good for stocks. The economy is alive and well. It's not lower tax rates. This is a supply-side tax cut, and it's going to increase the economy's potential to grow. But the dollar is absolutely essential. Yes, Evan.
Larry,
yes.
It's Evan. Okay. You and Steve, and even maybe a little bit Surratt, you're talking about these issues as if somebody has the ability to fine-tune all this stuff on the margin. You're talking about 0.1% increases of CPI and all these. The big jumps that we will see will not be because people are suddenly paying a lot more for their cornflakes over Amazon. It'll be because wages finally take off. It'll be because there's labor pressures. It'll be because things happen that are not just about the internet, but it's about labor union organizing airports or things like that all of a sudden. Isn't that much more likely?
No, that's exactly what I'm arguing against, okay? And actually, I want to give even more breaking news. Janet Yellen had this story right when she argued in a speech a couple of months ago before she retired from the Fed that the Fed's so-called tight labor market conditions causes inflation. And she said that model hasn't worked in 20 years. And she's right.
And Larry, can I just add to that, Larry?
Let me make another point.
Wages are only inflationary when they grow quicker than productivity. That's all I want to say. It's not inflationary for wages to go up.
All I want to say is, if the Federal Reserve, this is primarily a Fed issue now, if the Federal Reserve permits the dollar to keep falling, okay?
You think it's the Fed, Larry, it's not these deficits? It seems like the only possible explanation right now.
Yeah, no, I don't. I think the dollar is the key, and I think you should focus on the dollar. Inflation is not about wages.
But if the Fed's tightening, how is it their fault that the dollar's falling?
Well, look, this is a signal, Kelly, that there are too many dollars out there. That the Fed has printed too many dollars. And they will. They're going to have to bring in their balance sheet.
Hold on, Larry.
They're going to have to retire reserves, and they'll watch the dollar as a benchmark.
You got a lot of people shaking their heads, Larry.
I mean, you have a federal government about to put $1.2 trillion more air into this particular balloon, Mr. Kudlow. And I think that if there's a source of inflation, at least at the outset of the, let me finish, at the outset of the tax cuts, which I think it's very hard to argue that the first year or even two has a supply side effect, because you can't buy the machines and put them in place and increase productivity. It takes some time, Larry, to do that. Well, the initial impulse is going to be inflationary.
This is where we disagree. This is where we disagree. Respectfully. All I'm saying, take a look at all the economic data.
All right.
We are at the front end of a huge business investment boom. And that is starting to react to the lower business tax rates. That is counterinflationary. That's like having a huge crop of apples and the prices are going to come down.
Surratt, we're going to give you the last word. Are you investing, Surratt, around a inflationary, weak dollar, high deficit kind of environment, or no?
I'm investing where I think rates are going to move up gradually. We might get these hiccups, but I want companies that have pricing power, that have the ability to actually increase their revenues and bottom lines, not just cut costs and keep on fighting for cutting, extraneous expenses.
All right, you sort of didn't, that was sort of a wishful.
So I would say what you want to do is avoid consumer staples, avoid telecom, avoid utilities, even some REITs, and you want to be in growth industrials, financials.
I think that's exactly the way.
What about cornflakes? Is there more? Is there pricing pressure in cornflakes? Do you have pricing power in cornflakes?
Guys, thank you very, very much. We appreciate your time on this Friday afternoon. That was great stuff. And Steve, have a good show tonight.